Hey guys, Cam McClellan here.
Michael Beresford here.
Welcome to today's Wealth WOD. I want to talk to you today about, and Michael's a big believer, and as am I, about setting up finance to keep your own home safe and separating assets with different lenders to keep each asset safe. Now, a lot of our investors and clients are getting to the stage now where they've got too many properties to keep with a couple of different banks. You run out of first tier banks. I feel sorry for you, you've got too many properties.
I love first world problems.
Yeah, that's it. But the stage two of this, and the way we've set our portfolios up is to group properties with banks by state. Now, I'm not saying use Bank of Queensland for your Queensland properties and Bank of Melbourne for Melbourne properties, but we'll go through a quick, I'll get Michael to go through a quick example on why it's important to group properties by state with a specific bank and how that maximises the amount of equity you can draw out to duplicate when a market goes up and stops, and it basically puts a stop in so that if markets don't go up in a specific area, it doesn't drag the overall portfolio down.
Cool. Got a question for you, Cam. If you've got a multi-billion-dollar property portfolio, would you like to have control over that or not? Yes or no?
I would. Felicity, my wife, has most of the control, but yes, I would.
Okay, so you guys would rather have the control than the bank. This is really what it's getting down to. Okay, so here we've got our four main capital city markets. As you guys know, we're advocates for capital city investing. Now, all of these markets here don't move together in terms of growth and sit flat together. They cycle, and that's the nature of how investments work.
It's the beauty about the Australian property market.
So let's draw some arrows here. How's the Sydney market been in the last 5 years?
Oh, it's been cranking.
Fantastic.
And it was overdue. It was 10 years flat before that, so it needed some growth.
How's Melbourne been? Excellent.
It's been pretty good. It follows Sydney.
Brisbane, pottering along, ready to move. Perth, the polar opposite to Sydney and Melbourne.
Yeah.
Right. So, let's say that you had 4 properties in your portfolio to illustrate the concept. This process, guys, while you're in the acquisition phase of your portfolio, it doesn't matter whether it's you're buying your first property or you're buying your 12th property, the same rationale applies, okay? So what we're looking at is, let's say that you've got one property in each of these 4 capital city markets. Now, if all of those properties are with the same bank, because you have a relationship with them, then the bank's going to be super happy for you to lend against this and this. Not so much here, and definitely not here, okay? So because the banks are in the business of risk mitigation, basically you're going to be limited on the amount of equity you can pull out of the portfolio because they'll basically take an average, right? So if Sydney's created 100,000 of equity, as has Melbourne, Brisbane's created 10 and Perth's gone back 80, right? Then essentially, back 80, then effectively what we've got here is 210,000 equity in growth, but we've got minus 80, okay, which gives us 120 overall. So let's say that we needed 150 to cover our next deposit and costs. This scenario is not working for us. Whereas if each of these properties are with a different lender and we need 150, well, we just go back to the banks that have the loans on the Sydney property and the Melbourne property. We take the equity that's available from both of those, piece them together, and we're off and running and adding to our portfolio. Okay, so that's the first part. The second part is when, like Cam was saying, when you get to a big portfolio, let's have a look at it and we say, right, well, we've run out of banks. What do we do? What we do then is ensure that all of the properties in one capital city market are with the same lender, because the chances are they're going to be going up together or sitting flat together. So you just want to avoid a situation where you're compromising a lender having property in a market that's moved positively and a market that's sitting flat or gone backwards. That allows you to retain the control, obtain the equity when you can, build the portfolio at the rate that you want, not when the bank says you can.
Yeah, and it's not a matter of not disclosing with each of the banks that you have borrowings with other banks. You're quite open about it, and it's sort of tough titties a little bit that, sorry, my Sydney properties are with X Bank. Sorry, my Melbourne are with you. That's fine. You can have my Melbourne, no more. So if you give me a favourable lending capacity on Melbourne, on your lending, I'll buy some more. Yeah? So you can start to leverage the bank's relationship a little bit.
You're calling the shots and you're able to move forward when you want, not when the bank says you can.
Cool, guys.
See you next time.